Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So, as you saw by the title of the video, today we're going to be diving into the 1950s and 1960s Buffett partnership. We all know Warren Buffett as this mega billionaire who's made great returns in the stock market for a very long period of time, but his best returns were actually made right back in his original partnership in the 50s and 60s. So I've actually been reading some of his sort of annual letters to shareholders from back in those partnership days. And there's some very interesting things that I think the everyday investor can take out of these letters and apply to their own investments. So I want to run through some reasons why Buffett did so well through that period. Besides him being a genius, there's plenty of reasons that he's done very well. But I'm going to try and narrow it down to sort of 3 or 4 main things that Buffett really did quite differently to others in the investment community, and what he did that allowed him to make very high returns. So in terms of the actual returns that were made, Buffett made on average through the 13-year lifetime of that partnership 29.5% per year before fees, which is ridiculous. Over the 13-year lifetime of that partnership, that would turn a $100,000 investment into about $1.7 million. And that compares to about only $250,000 if you'd invested in the Dow and reinvested your dividends and gone kind of that indexing route. So let's dive into this. As I say, if you enjoyed the video, hit like, hit subscribe. But without further ado, let's dive into the Buffett partnership. Alright, so the first thing that was very different in the Buffett partnership days versus the money that Warren Buffett's managing today is the sheer scale that he was working at and the number of opportunities that were actually available for him for investment. So Warren Buffett started his partnership with $105,100. Buffett put in $100 and the partners put in $105,000. So he started at a very low sort of level of capital. Over the period of time that the partnership ran, it grew. Obviously, he made phenomenal results through his investments, but he also got new investors kind of seeing this performance record build and build and build. Warren Buffett was continuing to crank out amazing numbers, and so he attracted a lot of new investment as well. And when he closed down the partnership in 1970, he actually closed with $105 million. So he grew the partnership to a huge extent, but in saying that, it's still peanuts compared to what he's investing today. So today, you know, Berkshire Hathaway, his company that he's managing and has been managing basically since 1970, has a market cap of $500 billion, $500 billion. So he's got a lot more money under management, and it's very hard to compound big amounts of money at a very high rate. Your universe is just smaller in terms of opportunities that are going to make a noticeable difference to your net worth. So that's really the first point. So Buffett was working with very small amounts of money. It meant that almost any stock on the planet was open to him for investment, whereas today he's really maybe only got 30, 40, 50, 60 companies at the most, I would say, on the planet that he can really get a huge amount of his portfolio into, because he does like to remain relatively concentrated and invest, you know, a lot of money when he's got a good idea. So that's the first thing. He was working with small amounts of money. The other thing that helped him to actually have a lot more opportunities than he does today is the market was a lot less efficient. So if you know anything about Buffett's strategy, he's looking for undervalued businesses. So he would look for a publicly traded company. He'd make an assessment of what he thinks that company would be worth to a private owner, do some sort of valuation on it, and then he'd look at the market cap of that business in the stock market. What were the shares, the pieces of that business trading for? So if he found an opportunity, for example, where he believed the value of that business to be $50 and he could buy the stock on the stock market for $25, he'd load up the truck on that opportunity. And back in the 50s, not so much in the 60s, which I'm sort of getting into in the letters now, but especially in the early days, there was not a huge amount of competition in terms of investors looking for these mispricings, and the availability of information was much poorer than it is today. So as soon as Apple, for example, releases their annual report or their quarterly results, I can see that within about 30 seconds of that announcement. You know, I can open up my phone, I can see what's happened, and that obviously wasn't the case in the 50s and 60s. So information was much more scarce. It took a long time for information to flow to different investors, and it gave rise to a much more opportunities in terms of mispricing and trying to pick up really good investments. So that's the first thing that I wanted to talk about. He had a lot more opportunities and a lot less money to manage, so he was able to crank out much higher returns because he could identify a lot of these mispricings. So that's the first thing. That's the first thing that Buffett was doing in the Buffett partnerships. Let's dive into the second thing that helped him really outperform the Dow over that period of time. Alright, so the second thing that allowed Buffett to outperform the market by so much for so long is something that I probably didn't have as much of an appreciation for initially as I should have when I was going into these letters. And that is the fact that Buffett didn't just buy undervalued stocks. So that was certainly his bread and butter, like I spoke about before. He was, trying to identify those 50-cent dollars. But he also invested in what he calls workouts. So basically he would identify oftentimes private businesses, sometimes still public businesses, but he'd buy so much of the stock that he'd have control of it. And essentially what it meant was that he could disassociate the returns of his partnership from what the Dow was doing. So if he had a private business, his results were very much dependent on how that business performs. And although that's also the case in the stock market over the long term, the price of the shares of that company are going to reflect the performance of the company. That is going to happen over the long term, but in the short term, the stock market, as we know, can be crazy. It can go very high, it can go very low, lots of up and downs in stocks. And having private businesses or businesses where he owned a huge amount of the stock and had a controlling interest in that company, maybe to get cash out of it or to have that business sell some assets or do something like that, it gave him a lot more control, and it meant that in periods of time where the Dow Jones went down, Buffett still had these very stable results coming in. His results were not dependent on what the stock market was doing. His results were dependent on how these workout situations themselves were actually tracking. So that actually was a really good benefit for Warren Buffett. So often relatively short-term situations, so maybe 6 months to a year to 2 years max typically. He was going in, really stripping these businesses down, selling off unnecessary assets and getting people in oftentimes to help return them to profitability. And that gave him, a really stable source of reliable returns. So it meant that if the Dow Jones went down 10%, that really didn't matter. He had this private business or business that he owned a huge chunk of, performing very well and going through this workout, which was really driving the returns. So in down years, it was great for Buffett. There were a couple of years where the stock market boomed along and Buffett really just couldn't keep up because he had a lot of his net worth and a lot of the assets of the partnership in these workout situations. But overall, it was really beneficial for him and definitely gave him an edge over the Dow Jones as his benchmark. So that's the second thing. Let's get into the third reason why Buffett was crushing the Dow Jones. The third and final reason that I want to dive into around Buffett massively outperforming the Dow Jones and crushing the stock market over a long period of time through his original partnerships is that he wasn't afraid to be really different from the crowd. And this is probably one of the biggest reasons why he did very well. So in a lot of his annual letters to shareholders through that period, he compared the results of the Buffett partnership versus very popular mutual funds and that sort of thing of the time. And what you'd often see is that the mutual funds would almost always have performance that basically mirrored the performance of the Dow Jones index. So those mutual funds were heavily diversified across stocks. If the stock market did well, the mutual funds would do pretty well minus some fees. If the stock market dropped, then the mutual fund would also drop to a similar extent. So they were very tightly linked to the Dow Jones just because they had huge diversification. They were basically indexing, and Buffett wasn't afraid to stray from that strategy. So he'd obviously come out of Columbia University, been educated by Ben Graham in value investing. He knew how to value businesses and he knew how to identify really good investments, and that meant that When investment opportunities were scarce, which they did get rather scarce for Buffett towards the end of his partnership years, prices had come up, more competition had come in, there were less of these mispriced sort of opportunities. It meant that when Buffett did find something that he was extremely confident on, he actually added a ground rule into the Buffett partnership sort of agreement for investors that he was able to invest up to 40% of all of the assets under management into a single security. So he was extremely confident and often extremely concentrated when great opportunities did rise, and he took a really big advantage of those opportunities. So, he states very openly that he would love to be spread across 25 or 30 stocks, all of which he was confident were statistically looking like they were going to do very well. But that's just not the reality in investing. You don't have a whole bunch of different opportunities that are all equally as good. You have different companies that have different risk profiles, different return profiles, and in some cases the returns looked phenomenal, the risks looked next to none, and Buffett took massive advantage of those, invested a big chunk of the portfolio into those stocks, and meant that there was a little bit more volatility year to year because his results were obviously very dependent on one stock moving up or down. But over the long term, his results were far better than the Dow Jones because he'd identify these great opportunities, he'd focus on those ones rather than spreading his money thinly and widely around a number of stocks just for the sake of diversification and safety. And you'll notice that actually in a lot of the down years in the Dow Jones, Buffett actually did much better. That was really the years where he had the biggest gap between himself and the Dow. The Dow would go down and he would do extremely well. If the Dow would go up, he'd still be ahead of the Dow, but often not by quite as much. So it was in those down years that he did extremely well, and that's because he was investing in these value opportunities. So if you buy $1 for 50 cents, there's much less downside risk than buying it for that full price dollar. It's often not going to go to 40 or 30 or 25 cents on the dollar if it's already cheap, and it also creates a lot more upside. So for that 50 cents to get back to an intrinsic value of $1, it has to double, and then you've made 100% return. So that's exactly the strategy that Buffett was taking, and those are some of my big learnings from reading these letters so far. So I'm going to actually link the letters down in the description below, so if you're interested in printing them out yourself and having a read, I would highly recommend it, and I hope you do get a chance to do that. But that's all from me today. I hope you enjoyed the video. If you did, hit like, hit subscribe. You can watch other videos, I think, over that side. I know I get this wrong every time. Pretty sure it's over that side. Subscribe over there, and I'll see you in the next one. Cheers.